increasing the prospects of success of business acquisitions. Although there is no magic formula for assuring the success of an intended corporate business acquisition, there are numerous aspects that demand serious consideration and investigation prior to proceeding with any business acquisition. As such, it is extremely beneficial to look at certain commonly overlooked aspects leading into the purchase of a business, which have the potential of better optimizing the results that you are capable of realizing. The hidden psychology of the seller. The motivations driving a seller to exit their business are often far more complex than the financial figures presented in a prospectus. While a buyer might focus on the balance sheet, they frequently overlook the emotional attachment or the underlying stressors that have led to the decision to sell. Understanding whether a seller is burnt out, facing health issues, or perhaps anticipating a market downturn provides critical context for the negotiation process. If a seller is deeply emotionally invested, they may subconsciously sabotage the transition or hold unrealistic expectations regarding the company's valuation. By uncovering these psychological drivers early, an acquirer can tailor their approach to ensure a smoother handover of leadership. Cultural compatibility and workforce integration. One of the most frequent causes of failed acquisitions is the clash of organizational cultures that was never properly assessed during the preliminary stages. Every business develops its own unique language, set of values, and informal power structures that do not appear on an organizational chart. When a larger corporation absorbs a smaller, more agile startup, the resulting friction can lead to a mass exodus of talent and a sharp decline in productivity. Ignoring the human element of a merger often results in a toxic work environment where employees feel undervalued and misunderstood. True due diligence must include a deep dive into how work actually gets done and whether the two teams can realistically coexist. The quality and sustainability of earnings. Financial due diligence often stops at verifying historical revenue, but it frequently fails to analyze the long-term sustainability of those earnings. It is vital to determine if a recent spike in profits was manufactured through aggressive cost-cutting or a one-time surge in market demand that is unlikely to repeat. A buyer must scrutinize the customer concentration levels to ensure the business is not overly dependent on a handful of clients who might leave after the sale. If a significant portion of the revenue is tied to personal relationships held by the outgoing owner, that value may vanish the moment the deal is closed. Investigating the quality of earnings means looking beyond the raw numbers to find the recurring and reliable core of the enterprise. Undisclosed liabilities and legal encumbrances. Beyond the obvious debts listed on a balance sheet, many businesses carry off-balance sheet liabilities that can haunt an unsuspecting buyer for years. These might include pending litigation, unresolved environmental issues, or unfavorable long-term contracts that are difficult to terminate. A thorough investigation should also look for intellectual property disputes or unclear ownership of key proprietary technologies that are essential to the business. Failing to perform a comprehensive legal audit can result in the buyer inheriting massive financial burdens that were never factored into the purchase price. Rigorous due diligence requires a proactive search for these skeletons in the closet through public record searches and detailed interviews with management. Technology infrastructure and technical debt. In the modern era, the state of a company's technology stack is a primary indicator of its future scalability and operational health. Many buyers overlook that technical debt accumulated through years of using outdated software, unpatched security systems, or poorly documented code. If the underlying systems require a complete overhaul to remain competitive, the true cost of the acquisition is significantly higher than the sticker price. An aging infrastructure not only poses a security risk, but also limits the ability of the buyer to integrate with their existing platforms. Assessing the health of the information technology department is just as critical as auditing the financial department in today's digital economy. Regulatory compliance and changing landscapes. A business that is currently profitable might be operating on the edge of evolving industry regulations that could threaten its entire model. Due diligence must involve an analysis of upcoming legislative changes that could increase compliance costs or render certain products obsolete. For instance, new data privacy laws or environmental standards can impose sudden heavy capital expenditures that the current owners have not prepared for. If the buyer does not account for these shifting sands, they may find themselves owning a business that is no longer legally or economically viable. Monitoring the political and regulatory climate surrounding the industry is an essential component of a sophisticated acquisition strategy. Customer sentiment and brand reputation. The perception of a brand in the eyes of its customers is an intangible asset that is incredibly difficult to quantify but essential to maintain. While a company may show strong historical sales, a quiet decline in customer satisfaction or a tarnished reputation on social media can signal future trouble. Acquirers often fail to conduct independent market research, relying instead on the data provided by the seller, which is naturally biased. Talking to current and former customers can reveal underlying issues with product quality or service reliability that the financial statements hide. Protecting the brand's integrity starts with knowing exactly how the market perceives the business before the ownership changes hands. Operational dependencies on the current owner. Many small to medium-sized enterprises suffer from key person risk, where the business cannot function effectively without the daily involvement of the founder. If the owner holds all the key relationships, specialized knowledge, and decision-making authority, the company's value is inherently tied to their presence. A buyer should investigate whether there are documented processes and a capable management team ready to take the reins. Without a structured transition plan, the departure of the owner can lead to operational chaos and a loss of institutional knowledge. Assessing the level of owner dependency is a crucial step in determining the true autonomy and resilience of the target company. Supply chain resilience and vendor relationships. The stability of a business is at the mercy of its suppliers, yet supply chain due diligence is frequently treated as a secondary concern. An acquirer needs to know if the target business relies on a single source for critical raw materials or if its primary vendors are themselves financially unstable. Changes in ownership sometimes trigger change of control clauses in vendor contracts, leading to price hikes or even the termination of essential services. Investigating the strength and diversity of the supply chain ensures that the business can continue to operate smoothly during global disruptions. A resilient business must have a diversified network of partners to survive the inevitable fluctuations in the global market. The true cost of synergies and integration. Buyers often justify a high purchase price by projecting synergies, the idea that the combined companies will be more efficient and profitable than they were separately. However, these projected savings are notoriously difficult to achieve and are frequently overestimated during the excitement of the deal. Integration costs, such as merging disparate payroll systems, rebranding, and physical office moves, can quickly erode any expected financial gains. A realistic due diligence process requires a granular breakdown of how these synergies will actually be realized and at what cost. Over-reliance on theoretical synergies without a concrete execution plan is a recipe for post-acquisition disappointment and financial strain. Intellectual property and proprietary knowledge. Protecting the competitive advantage of an acquired company requires a meticulous audit of its intellectual property portfolio, including patents, trademarks, and trade secrets. Many businesses claim to own proprietary processes that are actually common industry knowledge, or worse, infringe on the rights of others. It is also important to ensure that employment contracts clearly state that any inventions created by staff belong to the company, not the individuals. If the secret sauce in the business is not legally protected, competitors can easily replicate the model and erode the value of the acquisition. Ensuring the legal fortress around the company's innovations is airtight is a fundamental part of the investigative process. Post-acquisition strategic alignment. The final and perhaps most overlooked aspect of an acquisition is how the new entity fits into the buyer's long-term strategic vision. It is easy to get caught up in the thrill of the transaction and lose sight of whether the acquisition actually moves the buyer towards their ultimate goals. Due diligence should involve a rigorous stress test of the acquisition's role in the buyer's portfolio over the next 5 to 10 years. If the new business requires too much management attention or distracts from the core mission, it may become a burden rather than an asset. A successful acquisition is not just about buying a good company, it's about buying the right company for your specific future. To learn more about our law firm's business acquisition legal practice, we welcome you to visit our website and contact our law firm to schedule an initial consultation. Thank you.